Hello everyone, welcome back to Wealth Growth Club. Today, let's walk through Redington Ltd, a big name in technology distribution. I will break down the important numbers and what they mean. Let's start with sales. About 10 years ago, Redington was making 28,000 crores in sales. This year, sales shot up to just over 1,04,000 crores. That's nearly 4 times bigger in a decade, or about 12% growth on average every year. The past 3 years were even better, 17% per year, and just in the latest year, sales grew by 11.18%. So, Redington's growth has been impressively stable and consistent. No wild swings or sudden drops. It's basically steady progress, quarter after quarter. Now, what does it take to make those sales? Let's look at expenses. Redington spends a lot on buying and moving products. 94 to 95% of cost are material cost every year. That's because Redington is a distributor, moving tech products from brands to thousands of partners and stores. Employee costs are just 1 to 2% of expenses, so it keeps staffing lean. All other costs like rent and admin are minimal, about 2% of expenses. Their expenses move mostly in line with sales. So when sales go up, costs go up too, but margins stay under control. Now we will check operating profit, the money left after all those expenses. Redington's operating profit grew from 684 crore 10 years ago to 2058 crores this year. The operating profit margin is around 2% most years. That means for every 100 rupees sold, the company keeps 2 rupees as profit. It sounds small, but that's normal for distributors who work on high volume, low margin. Let's talk about the extra bits: other income, interest, and depreciation. Other income isn't a big part, just 850 crores this year, compared to profits from the main business. Interest costs are moderate, 341 crores in the latest year, showing some borrowing but not worrying. Depreciation, the value lost from assets getting older, is 220 crores, which is steady. And finally, Redington's net profit climbed from 358 crores 10 years ago to 1837 crores this year, and earnings per share jumped from 4.21 rupees to 20.9 rupees. Again, the growth is steady, without big crashes or sudden spikes. Now, let's look at dividends and returns. Dividend yield is solid at 2.79%, meaning you get back a bit of cash every year just for holding the stock. And return on equity is 14.4%. Not industry leading, but healthy for a distribution company. Redington pays out about 18 to 40% of profits as dividends most years. So, overall, Redington is a great example of a stable, consistently growing company. Sales and profits move up year after year. Margins stay the same, and the business avoids big risks or sharp downturns. It makes money mostly by moving huge volumes of products. Think of it as the backbone behind tech supply in India, the Middle East, and more. If you want a stock that grows slowly and surely, pays dividends, and doesn't give you heart attacks on earnings day, Redington is worth adding to your watch list. If you found this sort of breakdown helpful, subscribe to Wealth Growth Club and let me know which company you want me to explain next.